Okay. So, we talked about, last chapter, we studied the Schedule A, right? I told you there was a whole alphabet of schedules. We studied the Schedule A, which was for our itemized deductions. We looked at the Schedule B back in chapter 3 when we were talking about different types of income. Remember, that was for interest and dividends. Now we're moving on to Schedule C. Schedule C is the form that is used for businesses, for self-employed businesses, and it is part of the 1040, okay? So it's not a separate tax return, it becomes part of and a supplement to that Form 1040. Profit or loss from business, this is essentially an income statement, okay? Now, you'll notice on here, if you actually look at it, there are a lot of, and we'll go through these, but there are a lot of forms that have supplemental schedules as well that then feed into this Schedule C. Okay, just like we saw with the schedule, the Schedule A, well, the Schedule 1, a lot of other forms feed into that Schedule 1. The Schedule A, we had the non-cash contributions. We would have to fill that out separately, then that feeds into the Schedule A. So we have supplemental forms as well here that feed into this Schedule C. Ultimately, the Schedule C feeds into the Schedule 1, which then feeds into the 1040, okay? So, like I said, it's just an income statement, so don't be too intimidated by it. At the very top, we have information about the business. So the name, now if the business doesn't have a separate name, then it's just the name of the person that owns the business. If the business has its own employer ID number, and we talked about that, if you recall, in payroll accounting, if it has its own tax ID number, which is very common, even if it's a sole proprietorship, for it to have its own tax ID number, oftentimes banks will require it if you want to set up a bank account for your business. It's listed here. If there is no separate tax ID number, then it's just the Social Security number of the individual that would be listed on this form. Business name, if there is no separate business name, you don't have to put anything there. Business address, it could be the address of the taxpayer, right? Or it could be a separate address as well. Accounting method, cash, accrual, or other. For the most part, we're going to talk about cash accounting. There are certain instances where accrual accounting would be used for a sole proprietorship. They're for very large sole proprietorships. Most of those businesses, if they're that big, they're going to be organized in a different way, most likely. But for the most part, we are on a cash basis. And we talked about cash basis accounting right at the very start of this class, that we are going to record our income when we receive it, not when we earn it, and we're going to record our expenses when we incur them, right? So we don't have those accruals and prepaids and all of that stuff. Some questions about material participation. They ask this because this is active income. As active income, it is going to be subject to Social Security and Medicare taxes, just like wages are. If it is passive income, other examples of passive income: interest, dividends, capital gains. Passive income is when you put money into something and the money does the work, not you, right? I hope we all can get to that point someday. I'm not sure I'm ever going to get there, but I would say, active income is for chumps, and I'm a chump. So, but passive income, if somebody did not materially participate in this business, then there's a good chance that this income is going to be treated differently, more like investment income. Okay? They have to actually materially participate, and there is a specific definition for material participation. We're not going to go into it, but there are certain factors that are looked at to determine whether somebody has materially participated. Some other questions, one about 1099s. Did you make any payments to somebody that would require you to file a 1099? So 1099s have to be filed if you make a payment to a contractor that's over $600 during the year. So even if you're a contractor, you may pay other contractors to do work. And if you do, you may have to file a 1099. So there's questions about that. I don't know why this would ever be checked no. So it says if yes, so the first one is, did you make any payments that would require you to file a 1099? Yes or no? If the answer is yes, the next question is, did you or will you file? Well, yes, of course I'm going to. I'm not going to tell you, IRS, that I'm not going to follow your rules, right? But so the answer would only be yes. Part 1, income. So we've got gross receipts or sales, and we've got a couple of different types of business. We could have a service business, or we could have a manufacturing business, we could have a sales business, lots of different types of income. Whatever the gross income is, we're going to put it on this line. If we're selling something, we might have some returns and allowances. Does any of this look familiar? Returns and allowances, cost of goods sold, gross profit. This is yeah. So we're looking at cost of goods sold here. So if it's a service business, we're probably not going to enter anything. We don't really have cost of goods sold. If, however, we're manufacturing something or reselling items, then we are going to have a cost of goods sold section. The cost of goods sold is calculated actually on the back of this form, and I'll go through that for you. So all of these items, cost of goods sold, which comes from the other side of this form, to our gross profit, other income, so anything that's not related to our regular, what we normally do to earn income. Oops, stop it. And it says including gasoline or fuel tax credits or refunds and that sort of thing, to get to our gross income, line 7. This down here is our expenses. Now, obviously, there can be a lot more types of expenses than just what's listed here. But on here are the big ones, right? So advertising, car and truck expenses. So we're going to get to that section because that's got special rules with it. That's that travel and transportation part. Also, it could be, depreciation is down here. Commissions and fees, contract labor. So if you paid somebody else, another independent contractor. Depletion, we're not really going to talk about that, but depletion, I don't know if you've had 132 or intermediate. I think that's where they talk about depletion. So if you're extracting anything from the earth, that is depleting that particular asset. So there is a depletion, which is related to depreciation in that the value of the asset is going down as it's being used, but we're not going to talk too much about depletion. Depreciation. So this is the section, this is line 13, that we're going to talk a lot about. Depreciation and section 179, expense deduction. That is part of depreciation. We'll get to that. You'll hear, though, you'll become very familiar with that term 179 deduction. Okay? 179 deduction is a very popular deduction for businesses. And we often refer to these by their numbers or their letters, that sort of thing. Benefits, employee benefits, insurance other than health. Health insurance may be reported elsewhere. And remember, if you're self-employed and it's your health insurance, you may get to report it on as the self-employed health insurance deduction, right, separately on your Schedule 1. Interest expense, mortgages, legal and professional services, that would include accounting services, that sort of thing. Office expense, pensions, rent or lease. So if you're renting a space for your business, that expense would be there. Or if you rent equipment for your business, that also would go there. So any type of rent. Repairs and maintenance on items that you are assets and items that you're using in your business. Supplies. So supplies not included in part 3. Part 3 is our cost of goods sold. Okay, so these are other types of kind of miscellaneous supplies. Taxes and licenses, so sales taxes that might be included in the income. Property taxes, if you have any licensing fees, that sort of thing. Usually you have annual fees that you have to pay to the state for registration of your business, that sort of thing. travel and meals. We are going to get into this in more detail as well. Utilities, that's pretty self-explanatory. Wages, so even though you are self-employed, you may have employees. So you've got to follow those rules that are discussed in payroll accounting with regard to paying those wages, withholding taxes, and all of that stuff. So if you paid wages, those would be listed, and then we have our catch-all of other expenses. So it's anything that doesn't really fit, which could be a lot of things, right? You'll find when you're doing your homework, and especially the tax return problem, you might put something in a different place than where the publishers put it. Think about something like telephone expense. Okay, so telephone. Well, is that an office expense? Is that a utility expense? You know, there's some gray area there. When you're actually practicing and doing this stuff, you can make some executive decisions about where things go. And if you don't, if I was ever in doubt about which category I should put it in, I would just create another category and put it under other and list it out separately. Things like website. Okay, well, what's website? Is that a professional service? Is that an office expense? Is that, you know, it could go in all sorts of different categories. So we have our income up here, minus all of our expenses, which are totaled here. We arrive at our tentative profit or loss. We might have a loss. If our expenses exceed our income, then we have a loss. And that loss could offset other income on your tax return. It's one of the benefits of having your own business as well, is the fact that it could help you tax-wise with other income. Now, the IRS will start, if you have a loss start having a loss for 3 years or more, they start to look a little bit more carefully at your business. Doesn't mean that it's not legitimate. Certainly still could be legitimate, but they do start to ask questions. Next section down here, so we've got our tentative profit or loss. Tentative meaning we're not quite done, right? We've got more stuff that we've got to do. Next section, expenses for business use of your home. So that's the home office deduction, which we're going to go through. Attach form 8829, so you know we're going to look at that 8829 in this chapter. There are a couple of methods of doing that. There's a simplified method, and then there's an actual expenses method. We'll go through those when we get to that section as well. And then after subtracting that, we get to our net profit or loss. And it says here, if it's a profit, enter on Schedule 1, here's our Schedule 1, line 3, and on Schedule SE, line 2. Schedule SE is where we calculate our self-employment tax. Okay? That is what our tax is based on after all of those expenses. Not on our gross income, but on the net after those expenses. So you can see how that can be kind of beneficial, right? A lot of people, there's a lot of fraud associated with small businesses, and you can imagine why that would be. You just throw on a bunch of personal expenses and you call them business expenses. That, of course, is not legal. They do have to be legitimate business expenses, and that's the next section here. We're going to talk about what those business expenses would be. Part 3 is where we calculate cost of goods sold. This is just like you do for, is it like a perpetual inventory system? I can't remember. I think it's, well, or period. I can't keep those straight. I don't do financial accounting. So we have our beginning inventory plus our purchases, our cost of labor, less our purchases, cost of labor, materials and supplies, any other costs, and then our inventory at the end of the year. We subtract all that and we get our cost of goods sold, and that's what gets transferred over to the other page. Now, I had mentioned that we use cash basis accounting 99% of the time. Very rarely do you, for a small business, for a sole proprietorship, would you use an accrual basis of accounting. However, if your small business has inventory, then you do use accrual accounting to account for the inventory. All the other expenses are on a cash basis, but the inventory is accounted for on an accrual basis, which means you don't get to expense all of the purchases that you make until you actually sell those items, right? Whether you're manufacturing or whether you're reselling. So you can't just buy a bunch of inventory and then expense it immediately. You gotta wait until you actually sell it.
Oh, I got a question.
Yeah.
What if it's a service?
If it's a service, then you wouldn't even have cost of goods sold. Yeah.
Because I'm just thinking, like, my cousin has a cleaning service.
Yeah.
She has inventory for her cleaning supplies.
Well, for her supplies, yeah, but that would be more supplies for her cleaning. Yeah, she's not purchasing bottles of cleaner to then resell to her clients. She's actually using those in her business. Yep. Good question though. Any other questions? Okay. So this part is related to transportation. Now we have an additional form that is also related to transportation. This is kind of a simplified form. But if we have a vehicle that is used regularly in a business, we're actually going to be, well, chances are we're going to be using the same depreciation form for accounting for those expenses. But this, so when did you place your vehicle in services? Total number of miles that you drove, and then all of that broken down. How many of those miles was for business? How many was for commuting, which is not deductible? And then other types of miles. The only ones that are deductible would be these over here, but they want to know all of it. Was your vehicle available for personal use? Do you have another vehicle available? Do you have evidence to support your deduction? Again, this is another one where you always want to check yes. You don't want to say, no, I'm just claiming this, I just made it up, pulled it out of the air. Is the evidence written? That's another one. You want that to be written evidence. So this is the space for other expenses. As you can see, it's very short. So what normally happens is with the software, if you've got other expenses listed, it will print out a supplemental schedule that just continues that, okay? And that's very common for that to happen. All right. Let's see if there's anything here that I really want to say. So they do talk about here, if an activity produces a profit, there's usually no problem calling it a trade or business. So with hobbies, for example, when we're making that distinction between a hobby and a trade or business, usually if you're actually making money, that means you're paying tax on it, so the IRS usually isn't too concerned about it. However, when losses result from an activity, the IRS starts to question whether there's a profit motive. They may question whether you actually are in the business in order to make money, or if you're using it as some sort of tax shelter or for some other purpose, right? So you need to be able to establish that that activity is a trade or business. So it's fundamentally an income statement. I already mentioned that. Oh, I didn't mention the business codes. Let's see. So there is this part B here. Each type of business has a code. I think it's an NCIS code, something like that. It has to do with the federal government lists these different codes, and there's like hundreds of them. So if you are a floral shop that has deliveries, you've got a particular code that you put in there. So that just defines essentially, what your main business is. But that list is online. And sometimes it can be kind of difficult to determine what the code should actually be. Let's see. Okay, so this part here, so if you have gross receipts of less than 27 million and they take a 3-year average, then you can use the cash method of accounting. Unless inventory is a material income producing factor, then you've got to use the accrual method for your inventory. But you can see that 27 million, I mean, that's pretty high for an average 3-year period. Yeah.
You said except, but it says even if.
Let's see. Even if, well, did they change that? Let's see. Businesses with gross receipts less than, okay. So even if inventory is a material income producing factor, you can use accrual accounting, but for the inventory itself, you have to use accrual accounting. For everything else, you can use cash accounting,
Okay.
okay? And I'm not sure. Before that, I think it was, so you still can't expense like your purchases of items that you're going to resell. This is just for everything else. I'm pretty sure, I will double check on that, but I'm pretty sure that's still the case. Do you see the distinction that I'm talking about?
Mm-hmm.
Really, or are you being polite?
No, I do.
Okay.
I'm writing notes at the same time.
Okay, yep. So businesses with gross receipts less than 27 million over a 3-year average can use the cash method of accounting, even if inventory is a material income producing factor. But, where is it here? They redid the wording on that. Yeah, we're not gonna talk about passive activities. Let's see here. I will double check on that, but my understanding is that the inventory part still has to be accrual accounting. So you can't just buy up a bunch of inventory at the end of the year if you haven't, unless you sell it, then you get to expense it. But for everything else, it's a cash basis. Okay, other questions?